Welcome to the video portion of Personal Finance. This is what Greg Arrowwood looks like, live and in person. Well, I'm live now, and I hope to be alive whenever you see this. What we're talking about today is investment asset allocation. Now, we're talking about financial assets. And what's the difference between a financial asset and, for example, real property or personal property? Well, the difference is if you drop financial assets on your foot, it will not hurt you. That would be a size 14. Yes, thank you very much. But financial assets are intangible. They're not like houses or cars or any kind of equipment. What are financial assets? We're going to talk about that right now. We're going to illustrate asset allocation through the use of the investment allocation pyramid. This was developed about 30 years ago by a large multinational well-known brokerage firm and has since been filtered throughout the entire financial planning and financial services industry. Theirs may not look exactly like this, but it's based on these fundamentals. Why do we use a pyramid? Because what's on the bottom of the pyramid? Something foundational, something that supports the things at the higher levels. So let's jump into it. Tier 1, what are we looking at? Tier 1, and there is a screenshot of this pyramid that will also be on Blackboard as a still photo that you can refer to as well. Tier 1 is safety. These are assets that even after September 11th and even after the 2008 financial collapse on Wall Street, these assets did nothing. They lost not a single penny's worth of value. They're things like insured bank accounts, such as certificates of deposit, money market accounts, U.S. Treasury securities, T-bills, T-notes, T-bonds, and also U.S. government agency securities like USDA bonds. The next tier is income. These are debt instruments that produce income to you, the investor, such as corporate bonds, tax-free municipal bonds that are issued by local and state governments. Also, convertible bonds that can be convertible years later at the investor's election into common stock. Tier 3, inflation hedge. This is important in some ages of your life cycle more than others. These include things like blue chip stocks. Now, what's a blue chip stock? Also known as a widows and orphans stock. These are large, well-capitalized companies that even in a severe economic recession or downturn, these companies are going to survive. The stock price may dip like many of the stocks prices did in late 2008, early 2009, but not a single blue chip company failed. So you may lose a little bit, especially if you get panicked and sell, but if you hold on, in all likelihood, you're going to make your money back fairly soon. And also blue chip mutual funds. More on mutual funds, which are basically a bucket filled with stocks of different companies, next week in Chapter 13. Then something that is next, Tier 4, is probably the most important of these tiers for most of you, and that is growth. That is how you get your money to grow rapidly. These are riskier companies, many of them technology, many of them from emerging markets, but they're companies that are smaller but still very, very large publicly traded companies. And Tier 5 is, I put here, high risk. They are not for everyone, and you need to limit the portion of your assets that are invested in these kind of things, such as commodities, futures, options, and commodities would include, of course, gold and oil. but limit that amount to a very small percentage of your portfolio. Why? Because as we go up the pyramid, risk increases such that corporate bonds have more risk than do U.S. Treasury securities. U.S. Treasury securities are direct obligations of the United States government and can't default. Corporate bonds, well, General Motors and Chrysler both have had defaults. Also, municipal bonds, Orange County, California, several years ago had a very large default of their municipal bonds, debt that they had issued for things like hospital projects, sewer projects, city infrastructure. Blue chip stocks. Now the difference between tier 2 and tier 3 is that these instruments represent debt of the companies or the municipalities. These instruments represent ownership. You actually own a portion of IBM or Walmart or whatever company whose stock you buy, or mutual funds that happen to own those companies. But as the risk increases, and of course growth stocks are riskier than blue chips, so do the rewards. And as my videographer comes this way, that looks stable to me, thank you very much. This is depicted graphically by charting rewards and risk, so that as you look at, and they're color coded, hopefully you can see that, but you could take zero risk in an investment with a U.S. Treasury bill. Now, you're only going to earn about 1/4 to 0.5% interest on it, but you won't have any risk, absolutely none. Corporate bonds have a little bit higher yield, but guess what? Remember, they can default. Blue chip stocks, you can expect a higher yield, but it's going to be a little bit of a rough, bumpy road, even though the overall trend has historically always been upward. There are dips. Sometimes the dips are big. Growth stocks, much higher rewards than even blue chip stocks, represents an ownership position, but again, is much riskier. And then options, for example, or commodities, or starting your own business. The rewards are, and I put dots in here to show just how much more potentially rewarding they are. However, they also are riskier than these other investments. You can easily lose everything in options in particular, or futures contracts. You can pause it now and or actually you can just bring it on over here and we'll let Athena edit it. Thank you very much for this, I appreciate it.